Hey everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmur and I'm a wealth advisor here at Creekmur Wealth. And today I'm flying solo. John is currently on the road meeting with clients, and so I am recording some thoughts that we'd put together while he was driving, and we're going to send it out to you guys. But definitely missed not having John here, but we'll still get in some great information here today. And so first and foremost, want to talk about some new offerings that our firm has been able to add on. One, of course, is something that we've talked about in weeks past, and that is the ability to help you with your Medicare and Medicare supplements. This is an area that right now we have just moved into the open sign-up season here in October. That runs through about the middle of December. So we have a few months here where if you are over the age of 65, or recently turned 65, or maybe will be turning 65 in the next 6 months or so, we would strongly encourage you to reach out. Nicole in our office here, she's an advisor, CFP, is heading this up for us. She's a wealth of knowledge on Medicare. We will include a webinar that Nicole prepared in the body of this email for you to watch, just walking through what Medicare is, Part A, Part B, drug plans, supplements, and a ton of great information is in there. So I would strongly encourage you to watch that webinar and then reach out to Nicole if you'd like some assistance in ensuring that you have the proper coverage on the Medicare side of things. Another new offer we have is the ability for us to actually help manage your HSA accounts or health savings accounts. This is something that we've been trying to get done for years, but it's proven a little bit tricky. So we are finally able to do that. The HSA accounts are actually at Fidelity, where we can actually have them invested in a wide range of investment opportunities, from ETFs, mutual funds, CDs, bonds. The whole world in the investment sphere is open to you, and that is something that we can help you with. So if you currently have an HSA or you would like to open an HSA, that is something that our firm can actually assist you with now. And for those of you who say, well, how do I get an HSA? You have to be covered by a high deductible health insurance plan in order to be able to open up a health savings account. One of the big positives with a health savings account is any contributions that you make to it through the course of the year are actually an income tax deduction. So it's a great way to help you save some money on taxes, to set aside money for future medical expenses. And a little known thing that not many people have heard about is once you turn 65 years old, you are actually able to withdraw those funds for any use. Before 65, you can only use those funds for health-related expenses. After the age of 65, that is kind of opened up, and you are now able to actually use those funds for other expenses as well. So we would strongly encourage you, if you do have a high deductible health insurance plan, having an HSA is a great tool to have in your overall financial plan. If you would like to talk about it, reach out to your advisor. They can help walk through the pros and cons. Or if you'd like to talk about management, that is something that we can definitely assist on there. And so let's transition here into some more financial and markets related topics. We're going to pop a chart up on the screen. This chart goes all the way back to the early 1990s. And these colors that you're seeing here are actually the interest expense. So essentially the interest the US government is paying on US treasuries. And obviously what you'll notice here is in the last year and a half or so, that number has exploded to a 30-year high. The US government is paying much higher interest on treasuries because interest rates have been increased at the fastest pace in history by the Federal Reserve. And as we've talked about many times, that was done in an effort to bring down overall inflation. And there has been some progress on that front. However, what we've seen is that the progress is beginning to slow, and inflation is a little bit stickier than what the Federal Reserve expected. And what this means in relation to broader markets is that it's very likely that interest rates will likely be increased a handful of times more here in the next 6 months or so. And then interest rates will be left at a higher rate and not really decreased unless there's a very large economic event that leads the Federal Reserve to have to increase rates at that time. And so obviously a massive increase in interest costs to the US government is additional funds that the government has to pay that in the past they have not. And we've obviously seen the national debt really accelerate and grow over the last 4 or 5 years. This is just another line item that is adding to the overall national debt. And so something for us to keep an eye on. It's something for us to be aware of. But at this point in time, we expect more interest rate increases and then rates to remain higher for longer until inflation is brought down to the 2% target that the Federal Reserve it expects to be at longer term. And so at this point, something to be aware of. Now on the flip side, we'll bring up another chart now here that actually shows over the last quarter how much interest some of the major companies here in the United States have earned on their cash and cash-like deposits. Apple almost made $1 billion in interest just from the cash they're holding on their balance sheet. Now, this interest is essentially for these companies is a buffer. It's always a good thing for these companies to make more money. As we've said many times, earnings are what drive companies forward. However, most of these companies are just simply reinvesting the interest that they earned back into treasury bills and other cash-like products. They're actually not reinvesting those funds back into their business at this time. And what we've seen so far in this over the last week in earnings reports is that many of the companies that have held up the market so far this year, you may have heard the phrase the Magnificent Seven or the Magnificent Eight. That's essentially the largest 7 to 8 companies in the US stock market. Apple, Amazon, Facebook, Google, Microsoft, Nvidia. These companies are responsible for over 85% of the total return in the S&P 500. And when we actually drill down underneath the surface of the 490 plus other companies, over half of them actually have a negative market return through this point in the year. And so what we've been watching very closely is how are these largest companies doing with their current earnings reports? What we've seen is Microsoft is by far and away the best leader in that area. They had very strong earnings growth in their cloud and artificial intelligence departments on top of their regular product lines. And so they actually continue to grow. Their stock actually has gone up here so far this week since that. However, on the flip side, a number of the other companies that have been holding up the market, such as Google or Apple, are actually beginning to see their earnings decrease or slow down, and they're beginning to miss some targets or expected targets with their earnings. And this is something we want to keep a very close eye on because these 8 companies are responsible for the market being positive so far this year. However, if their earnings begin to slow down, that is a risk to the broader stock market. And so earlier this week, many of you probably received notifications of our clients of trades that were placed inside of your accounts. And over the last year, we've been working with a team of certified financial analysts, CFAs, to build a market indicator that tells us when the market is beginning to change directions, either to the downside or to the upside. We actually received an alert earlier this week that now was the time to begin reducing risk or how much you have invested directly in the stock market. And so that is why trades were placed. We move funds out of the NASDAQ QQQ and SPY where we have strong earnings on the year. We rotated those over into a 1 to 3 month US Treasury bill fund that is currently paying a yield of 5%. And the goal with that was to protect the gains that we've made so far this year and to reduce the overall risk and volatility in your core passive equity funds. And so that was the trade that was placed earlier this year. I'm going to have a PDF included that will walk you through the rationale behind what we are calling the Trend Plus indicator. And so anytime you are building an indicator, no indicator is 100% accurate every single time. However, if we can be over 80% accurate, which is what we've seen so far, our hit rate's actually about 90% with this indicator, we are going to be able to ensure that we step aside whenever the markets begin to turn to the downside, and that whenever markets turn to the upside, we have a clear direction as to when to re-enter the markets. And so, been very pleased with this indicator so far this year. In August and in October, we've used it. And what we've seen from a performance standpoint is very, very encouraging that those were the right moves at those times. And so we'll include that PDF here. I definitely encourage you to read it. Overall, though, what I would tell all of you to do is if you've not had a conversation with your advisor recently about how much risk you have in your portfolio, I would strongly encourage you to reach out, schedule a 15-minute call, or even come into the office and have a conversation about it. Our advisors have been very proactive in reducing risk over the last 3 months, but it may be time to have a deeper conversation about where you're at in relation to your time frame for achieving some of the big financial goals that you have. Maybe it's retirement, maybe it's buying a home, maybe it's taking a trip, and what we can do to ensure that what's all going on in the world around us, in the economy and in the markets, do not have a negative impact on you achieving those goals. And we have a number of tools available, whether that's treasury bills or CDs, or a more fixed product that's paying a high guaranteed rate and protecting your principal, that can help ensure you're in the right place for what we believe is coming down the line here in the next 3 to 6 months in markets. And so strongly encourage you to reach out and have that conversation. Our team has been preparing and doing all the things on the back end to help position you properly, but it's 100% worth setting aside some time and having that conversation with them. So guys, thanks for your time. That's all I have today. If you have any question about an HSA or Medicare or what's going on in the markets and how it impacts your portfolio and your financial plan, we would encourage you to reach out. Our team is standing by and ready to have a conversation and here to help you in any way that we can. So thanks for the time, guys, and we'll talk to you soon.